Cheers, Kathleen. Okay, that's great. Really appreciate all your participation there. It makes my life a little easier. Makes me feel as though I'm not alone talking to this computer. So we appear to have a range of experience. So what I'll try and do is, as we're going through, I'll just give a little bit more information as we go, just for those of you who are less experienced. But for those of you who are experienced, I'm pretty sure that most of you won't have come across this before. So looking forward to sharing it with you. Now, a couple of things. I will do my best to answer any questions that we've got as we go through at various points, and also commit to, if we don't get a chance to answer any of the questions, I will follow up. I'll give you my email address, and feel free, please, to pop me a line through, and I'll do my best to answer what you need to know. Just a little bit about me. I don't want to spend too long on this because it's your webinar, not mine. So I'm 20 years a trader, and of that I've been 10 years a consultant coach on a one-to-one basis with some clients, and obviously a teacher, which is my primary background. I've worked with Hawkeye traders, which I'll tell you a little bit about in a moment, for almost 3 years. The founder and owner of Hawkeye Traders, Nigel Hawkes, who many of you will have heard speak before, met me in at an Australian Technical Analysis Association workshop where I was presenting, and wanted to add an options arm to Hawkeye Traders. They already at that stage had a Forex, equities and futures components, and spent some time with Nigel, picked his software to pieces, put it back together again in terms of an options context, and since then I've been working with them almost exclusively. As you may have detected, the accent isn't one that will be familiar to many of you. I'm from the UK originally. I've lived out in Australia, in a beautiful part of the world just north of Perth, for about 14 years now. And as I'm a teacher, the reason I do this is obviously to see it make a difference to traders. Passionate about seeing you guys get results. So please, as I said before, make sure you ask any questions. Now just take a note of that email address, mike@hawkeyeoptions.com. And as I said, anything that you want to follow up with, you're very, very welcome just to drop me a line personally, and I will endeavour to answer your question. Just an introduction to what Hawkeye is about, and I'll show you a chart in a moment to illustrate what I'm talking about. Right, that's Nigel Hawkes there. He, as I said, he spent many years trying to find a system which worked for him. Did what most of us have done in the early days and donated significant amounts of money to the market, and then came across volume spread analysis. And really the essence of VSA is that you're looking at really the leading indicator, which is volume, and its relationship to price. And what Hawkeye is, Hawkeye is a plugin which plugs into many platforms: TradeStation, Ninja, MT4, multi-charts. Although many people like myself use an options platform to trade, and trade using something like Ninja, which is obviously free if you want the end of day data. And Nigel's developed over the years many different tools to help us along the way in decision making. And of course, as many of the presenters have talked throughout your day, the principle of having a system that you initially test and then trade is very much part of Nigel's mantra. We use 3 time frames for entry decision making. So for example, for shorter term options trades, so directional trading, maybe weekly credit spreads, we'll use perhaps a 1 day, 2 day, 1 week. And for longer trades, we may use 1 day, 1 week, 1 month. And Hawkeye Options itself runs a trade alert and portfolio service, as well as additional education courses for for those who want to take things to an advanced level. And one of the things I'm going to talk about is one of the courses that we first ran a couple of years ago, and really is probably aimed more at those with some experience, and rather than those who are completely new. Although there were 4 guys who were completely new to options, and we put in some extra learning for them when they did the course, and they all rocked with it. They did really well. It didn't have any bad habits that most of us develop from time to time and have to readdress. So that's a little bit about Hawkeye. I'll just show you quickly. Here's an SLV chart. This is a trade. This is our trade alert from last night. Oh, sorry, from earlier in your day. And so really what Hawkeye is all about is volume. And just to explain what's going on here, there's our 3 time frames, our 1 day, 2 day, and 1 week. What Hawkeye shows you is there is a trend there, which can be green, red, or white, depending on the particular, whether it's up, down, or in congestion. And what we're looking for is a combination of the volume is not, although it shows the amount of volume, it also shows whether it's buying, selling, or neutral volume. So our ideal setup would be uptrend through, if we're going long, uptrend through a green trend dot, buying volume and a green, this is what we call a heat map. On our first time frame, buying volume on the other 2 time frames, and you'll see green come in here, and of course what we want to see is uptrend at least on the 2nd time frame as well. So that's, in essence, that's a system we utilize. So we may have entered SLV at this point here. Once it had broken these pivot highs here, that was really the entry there, and take advantage with a long call position as it moved up. We also put this out as an alert that if it broke this level here, we saw this as a key level. There's a pivots there, it was supported there was resistance there. So we saw this as a potential entry last night, and this is what the trade alerts look like. We wanted to see it break those pivots there to make sure that it was a trade that had continued a continued uptrend. So that's really what Hawkeye is about. Now that's not the major focus of the presentation, but I thought I'd give it some context in terms of some of the decision making we make. Now the other thing that you'll see on this chart is, as well as the bars, you'll see which again are 3 colors. Generally you'll see these occasional additional bars, these we call wide bars. See the purple bars here. Now these are absolute dynamite. This is my favorite indicator of all the Hawkeye suite for doing credit spreads. So what we normally do is if we see a wide bar developing, then we would tend to put a credit spread either side, depending on the direction we're trading. We may put it over the top of the wide bar if we're going short, or obviously a bull put spread if we're going long. So if we'd done that here, on this wide bar here, if we put a bull put spread here, we would have do less than, oh, apologies, sorry, that's mine. Thank you, Bill. Is that better? So there we go, there's the wide bar there. We could have put a credit spread directly underneath here. And obviously for the next, we'll do less than, thanks Bill, we'll do less than 2 weeks, is what we do with credit spreads, sometimes significantly less than 2 weeks. So we'll take that trade there, the bull put spread there, and profit from that one. There are a few rules around that, and I've sort of made a late decision to, if anybody is going to look with interest at the offer that we're going to make towards the back end of this presentation, I've put something else extra in for those of you who trade credit spreads and are interested in this wide bar type strategy, and I've translated that into sort of more standard indicators so you can get the vibe. But essentially a wide bar is a bar of extraordinary volatility intra-period, in this case intraday. So there again, you'll see here we could have taken a bull put spread here, and we could have done a bear call spread here. Okay, there we go. Now I've learned how to do the drawing on it. I'm probably use that a little more. Let's not talk about the S&P 500. Okay, so probably one of the earliest lessons that I learned, and one thing that I preach pretty vigorously, is if I look at the difference between all of those that I've worked with over the years who have done particularly well against those who perhaps haven't fulfilled their potential, then one of the major differences is the ones that perform well match strategy to market. So it's not just a case of reading a chart and trading one particular strategy. It's a case of reading a chart and then reading a market to choose the right strategy for the right market. For example, for most of last year, credit spreads weren't the ideal strategy to choose because the market was trading in a very tight range, which meant you were putting the spreads closer to the action if you wanted any, too close to the action if you wanted any return on investment. That's one of the key mistakes people doing credit spreads actually do. So having multiple strategies in your toolbox or golf clubs in your bag or whatever analogy you want to use is undoubtedly a strength when trading options. So most of what we do at Hawkeye Options is shorter term, but we do have some longer term strategies sort of in the bag that we use, and amongst those is diagonal call spreads, which are very similar for those of you less experienced. What you're doing is you're substituting the stock for a long-term bought call and then subsequently selling options over the top of that. Now, of course, we can do that up or down. So we can do a diagonal call spread or a diagonal put spread, just to take advantage of where we're at. What we're actually doing with this strategy is we're using the same principles that diagonal call spreads are based on, the same principles of covered calls, in that you have a longer term asset and then you sell shorter term calls over the top. So many of you will be familiar with this as a just let me know, how many of you trading covered calls? One of the, thanks guys, there's a few of you. So generally speaking, what we do is we buy a stock and then sell calls on a weekly stroke monthly basis, depending on how confident we are to do so. Some may even put or place a put protection underneath the whole position for a period of time, for say for 6 months. And ultimately, so the first few calls that you sell will essentially pay for your put position, and then obviously it's protected. And in markets like this, if you're doing a combination of timely roll downs and had a put protection in place, you would actually be fine in terms of where we are now, despite the drop we've had. Okay. Now, so this is really going to suit those of you who know covered calls and know something about spreads. Ooh. Because despite the theoretical attractiveness of 2 to 4% a month, which is the standard yield you would get from a covered call, really the cost of making a reasonable amount of premium, it can be pretty inhibitive, particularly to those who are finding their way in the market and haven't got hundreds of thousands in the market, which you would need to make if you like, a living income from covered calls. So 10 contracts of a $30 stock will cost $30,000 holding in one position. So that's often inhibitive for those who want to look at covered calls. The second and probably trickiest thing about covered calls or diagonal call spreads, or the strategy I'm going to talk to you about today, is sold call management. Generally speaking, the idea of just selling a call every month or every week rarely works if you don't take care and manage the call subsequently. It needs to be robust. You need to time the call sell well, potentially delay right sometime, alter the position according to what's happened to the underlying, so roll up and roll down. And most people don't do this, or if they do, they don't do it well. So those tend to be the issues with covered calls. So we could just buy long-term calls, and this is what we mean by a diagonal call spread. Because theoretically, a long-term call has the same risk profile as buying a stock with put protection underneath. So there's a capped risk there, and obviously still the potential for a move higher. Part of the problem with diagonal call spreads is we don't get that one-to-one movement, because it's a bought call we're holding rather than stock. So if we get a sudden move up in the underlying share, we tend to have to invest quite a lot of money buying the sold call option back, and with the underlying bought call not moving one to one, then we could actually be out of pocket or not made a profit at all, even though our position, our underlying share price has gone up significantly. What we do to try and mitigate that, just for information, is we usually have a fairly deeply in the money call if we're doing diagonal call spreads. So with this movement of the underlying share, as many of you who've traded options already will know, is all to do with one of the Greeks called delta. And for those of you less experienced, this is the amount the underlying option moves according to a 1 cent move in the share price. So if we had a delta of 0.5, which is usual for an at-the-money option, if the underlying share moves $1, then theoretically we would expect the option value to move 50 cents. So if we're not interested in covered calls because they're too expensive, and we have some issues with diagonal call spreads, then here's a potential idea. So what if you had exactly the same movement, one-to-one movement, as the underlying share? So rather than the bought call being the bought call of a diagonal call spread, you actually had full exposure to the movement of the share, and it didn't cost you a penny or a cent, depending on which country you come from. So that surely would be attractive. So if you could earn the movement to Apple and it not cost you anything, or GE, or any of the stocks that you care to choose, which are relatively liquid, I'm sure that would sound relatively attractive, yes? And so what you can then do, and you've got this no money down idea, which I'll explain in detail later, what you then can do is obviously put your long-term put protection in place. So you've got something that moves 1-for-1 with the share, doesn't cost you anything, you can put some protection in, and then of course you can sell some calls over the top. Does that sound interesting? Okay. So really what you're doing is you're substituting holding shares for having this no money down position. But in essence is exactly the same risk as holding the shares, because they move 1-for-1. And you're making exactly the same premium from your short calls. So in terms of an investment strategy, you could almost ask, well, why buy shares? Okay, there's an interesting theory. So what do we mean by no money down? Well, let's pick this apart a bit, okay, just so you get what I'm all about. So if we bought an at-the-money call position with a delta of 0.5, and let's say we bought it out for 4 or 5 months, this is a net delta of $2 a share. And because it has a delta of 0.5, because it's an at-the-money position, if there's an increase in the value of the underlying by $1, there's a move in the call option by 50 cents. So if we chose to close this, we would make 50 cents profit. Okay, nothing new or exciting there. Okay, so that's part one. Part two is at the same time we sell an at-the-money put position, then with a delta that's also 0.5, and we bring in $2 a share. So it might be that we buy a $30. I'm going to try and write with this. This is brave of me writing with a mouse. So we might buy a $30 call, but then sell a $30 put, bring in $2, and obviously if the underlying share moves up by $1, then there's a move in the put option by 50 cents. So the put option drops by 50 cents value. Therefore, if we buy to close, we make 50 cents profit. Okay, so the result of this is no cost, $2 out, $2 in, with a $1 move in the underlying, 50 cents and 50 cents equals $1. So there's our one-for-one movement, and it hasn't cost us a single cent. Obviously, the flip side of that is if it does go down, then you also get a one-to-one movement. So the reverse is the case too, as it is with shares. And there's no change in this, theoretically, even with time. So if we bought something that was 9 months out, cost us nothing, then with 3 months to go, theoretically, it still should cost us, it will still cost us nothing. Okay? The only change will be the change in the value of the underlying share. So no difference with shares. And it doesn't matter whether you do a 3 months, a 6 months, a 9 months, even at an 18-month option, it would still cost you nothing. Now, just a caveat on this. Obviously, dividends are part of option pricing, and I'll show you an example of this shortly, but these should be taken into account in the value of the option. So that's the theory of the no money down component. Now, if we have a look at a sort of real example, if you like. So here was SLV, and I took these prices when just before I had my little technical drama. So here was SLV at 14.95. So if we look at a September series and we look to something that's at the money, then there's our bid ask. This is just after market open. I just grabbed this from the NASDAQ. So this is our debit. So let's say we are paying 134. Okay, so that's minus. And here's our sold put. So we're doing, I've off the screen a little bit there we go. So let's say we got that for 132. Then it isn't quite no money down in this case. Our investment in this position to have one-to-one movement with the underlying share is a grand total of 2 cents a share. Okay, that's pretty impressive. Hey, beats spending $14.95 on exactly the same exposure. Now, the sold call, so if we looked at a March call and we sold slightly out of the money, let's say we sold a $16 call, and that brought us in, let's say, 24 cents. Then in month one, we're making 24 cents. Premium. Okay, so that's our return. So our cost at this stage is 2 cents, but we're going to put a put protection. We're going to put a put in for 2 reasons. First of all, we don't want the margin associated with a sold put position, and secondly, we want to protect the whole. So our put position let's put it $1 lower, not 50 cents lower. Oh, we could put it 50 cents lower. But let's put it $1 lower. Let's keep it consistent with one we'll talk about later. So that would cost us 85 cents a share. So our investment in this is going to be 85 cents for our put position, 2 cents, because that was the difference between our bought call and our sold put. So a total of perhaps 87 cents or 88 cents a share. And that's our return on month one. Now you can do the maths on that. That's in excess of 25%. So that's the essence of a no money down strategy. Okay, how does that sound? Good. Now, again, we've got a couple of things that we need to be careful of. First of all, of course, liquidity is an issue to get the desired fill. So we're going to do it on those options which are most liquid. And obviously, the longer out we go, the wider that bid-ask spread is going to be. Now we can put limit orders in, but we're going to have to, invariably, if we're going to have to, with most, we're going to have to give the market makers a little bit of a bonus to take the trade. And quite often we've found that the best, if you like, the best combination is to, first of all, buy the call, and then secondly, buy the put, essentially is a put spread. So do it in two transactions. You tend to get a better fill rather than doing the three as a combination trade, if that makes sense. Now, there are two ways to use this strategy. We can use a longer term approach and we would tend to go 6 to 12 months. Or we could do a more mercenary approach. So really looking for a 1 month kill. So if for example, that SLV trade did move up to $16, we'd probably rip that off the table. We'll have made probably 40 cents on the normally down position. We've made another 28 cents on the sold call. Would have had to give probably around about 25 cents back for the decrease in the value of the long-term bought put. So at the end of the day, we're about 60 cents up on an 88 cent per share trade, which in what's that? It's about 75% return. So that's one way of doing this. The other way of doing this is to look for that. Obviously, if you take it out longer, the cost of the put, which is the cost of this position, is more expensive, and hence, but you are selling repeated calls over the top. You need to find your own groove with what works with this, but there are some things which you really, really need to know. And I just want to put this warning out. There are some things which you really need to know, particularly with the sold call management, but also in terms of placement, of expiry date, and of course the underlying technical and fundamental issues going on with the stock. So there's about 8 different rules of the game relating to this, which we will be talking about for those of you who are choosing to progress. Now, the part of the power of this is we can mirror this strategy for a downward trading idea. So we'd flip the strategy over, and essentially we would be buying a put and selling a call as our no money. So it's essentially a short position. Buying a call as the protection above the position, so that would be the cost element, and then selling puts underneath. So it's if you like, a reverse no money down. What if you get called out, Garth? That's a great point, and it's one of the things you need to be careful of. Really, there are 2 occasions when you would be called out. Either obviously on expiry, if you don't do anything, if you just do nothing, never a good idea. And so you close it down prior to on expiry date. The second time which you may get called out early is around ex-dividend date. if your sold call is in the money. So you essentially legislate for that and make sure that you aren't in the money as ex-dividend date approaches. I'll go through another example in a minute, Vince. Okay, just to go over the what if you get put the stock. You have got the protection there of obviously the bought put. That hasn't happened to anybody doing this strategy that I'm aware of. Okay, so just on the put, without the put, long-term put, you've got no protection. It's all good, mate. You've got no protection, and you'll have a massive margin requirement due to the sold put. So neither of those is a desirable situation. So more often than not, we put a put one strike lower. So that gives us essentially a $1 in most cases increment maximum risk, and therefore the margin is $1 and the cost of the put. So that's your maximum risk. If you did nothing, if you just held the position, crossed your fingers, didn't sell any sold calls, that would be the maximum risk. So what you're trying to do is you're wanting an underlying, a move on the underlying which beats that, adding your so-called premium in, and that's where you profit. Sometimes we'll see a gross difference. If we enter a trade, sometimes we'll see a gross difference between the cost of the call and the cost of the put. Usually the put is more expensive, and this is usually due to dividends that are due. So you see this particularly on high yielding stocks. That's okay. You end up actually being paid to hold the position. It's actually a net credit position, buying the call and selling the put when that's the case. Again, I'll show you an example in a moment. But obviously the bought put is more expensive, so that tends to sort of even it all out a bit. We can also, there are a couple of guys doing this who actually buy the put higher than the normally down position. So hence a more expensive position, but no margin requirement, and also more protection on the downside. So here's Coke. I thought I'd give another example of one which sort of was like this. So here's Coke. It was trading early on at 42.20. So if we looked at a $42 call, sorry, a $42 no money down position. So there we've got a wider spread. So realistically, we'd probably be paying, this was early on, so the bid-ask spread was a bit wider, but let's say we paid $280 for that. Okay, so that's a debit of $280 for the bought call. Because Coke is a relatively high yielding stock, we see that higher put value. This is out to January, of course, as well. So you'll see there, we're probably selling the put. Let's say we got 345. It is closer to the bid side. So let's say we brought 345 in. Okay, so our normally down position is now a credit position for us of 65 cents. Okay, but if we look at our bought put position at 40, now here we're having to go to, because that's the only series that are available, and that might be one of the reasons why we may not choose a January, but I thought I'd give you another example. So we'd probably be paying around 265 for this. So that 265 is what it's costing us to hold the long-term put protection. We made 65 cents on the nominally down position, so the 42 bought call and sold put. So our total investment in this position is $2 a share. Okay. Now, if we went out to a March, Oh, I've snipped the, apologies, I've snipped off the, this is a 43 and a 44 from memory. Apologies, I've snipping off the strike prices. So if we even did a 44 for March, we'd still be bringing in excess of 10%. If we wanted to be a little more aggressive, we'd bring in 56 cents or a March sold call, which is still out of the money by 80 cents. So if it did get anywhere near that, our normally down position is going to benefit from that. Remember, it's 1-for-1 movement, so we'll be up 80 cents. Be up 80 cents on our normally down position. We'd have brought in 56 cents. Whoa. Okay, we're brought in 56 cents, so that's 136. But of course our put would have gone down, our bought put would have gone down, probably around about 40 cents. So we'd probably end up with around 90 cents per share profit for a $2 investment, which again is not bad for doing very little. If it didn't go up, stayed the same, then of course we've got 56 cents banked, which is about 27%. If it went down, obviously we'd have protection. We'd not only have an increase in the value of the bought put, but we'd also have brought in our 56 cents. And then of course we go again and we go again and we go again, right through to January 2017. Garth, I assume you're talking about when you say, are we going to go into adjustments in terms of rolling up or rolling down? I think that's what you mean. Time probably doesn't allow us to go into that in any detail, but it is an absolutely crucial part of managing this call well. What Garth's asking is should the underlying stock drop to a point where it looks as though it's not going to come back up again, then what we may do is close out our, let's say, our 43 call for March. So let's say it dropped 50, let's say it dropped 60 cents from here. It was down at around 41.50, dropped 70 cents. So probably cost us around about 20 cents to buy this call back, and then we could of course sell another call at 42, bring in another income. Now we do use technical signals to do that. Obviously, if something changes trend, whatever you will consider to be a sell signal for your particular trading system could be a roll down signal, and vice versa. Of course, you could roll up or buy the so-called back and subsequently delay right if you're seeing a buy signal. That's the only time you would ever buy a call back. You wouldn't prior to expiry. You would never buy a call back just because it's over your strike price. I've seen people do that and get hurt time and time again. You buy a so-called back expensive because it's popped a few cents over your strike price, and I wanted to see it drop back again. So there are rules of the game around that, and for those of you progressing, we're going to go through some of those rules in some detail. But great question, Garth, and thanks for bringing that up, because it is absolutely vitally important in being successful at this strategy. Obviously, we're only showing you a 1 month snapshot, which fits with the mercenary side of things, but in most cases, we're holding this for a number of months. And of course, it really doesn't matter where the underlying share goes. We can still sell calls over the top. Okay, and I remember an FXI position that we've only just recently closed. So that was around about 24% below our entry price, but because A, it was protected, and so our risk was capped, and secondly, because we just continued to sell weekly calls over FXI, which is the Chinese ETF, so not surprisingly it dropped significantly, then we ended up being still in excess of 80% in profit. We had a margin requirement issue to deal with, but again, we're going to cover that for those of you in detail for those of you moving forward. So let's just talk a little bit about the sold call. As we've said, we can use weekly or monthly, and this or both, a combination of two. Some of this may be dependent on underlying market conditions, and again, we're going to go through that step by step if you're going to move forward with us now. May choose to delay write it, which means we delay selling the call. So if we enter on a technical buy signal, so with SLV, we may not have actually, SLV was actually a straight bought call trade for the alert, but if that was a no money down position, then we probably wouldn't sell the call straight away anyway. We'd let the stock go up, which would get over some of your concerns there, Nizar, and subsequently sell the call when it looked as though it was starting to top out a little bit. Or we could just take the no money down position off and take the profit in that. There's nothing wrong with doing that if it continues to go up. If there's a sudden increase in the price of the stock, then that obviously is something that you have to manage. But because you've got a one-for-one movement of your NMD position, normally down position, sorry, then you're getting a far better deal than if you entered a diagonal call spread. You can easily roll the call up. What we tend to do is if there's a rapid move up in the stock, we tend to roll up not out of the money, but slightly in the money to give it some wiggle room to come back down for if there's any profit taken, and not shy at all of rolling it up again. There's times when we've rolled up 2 or 3 times within a monthly period, or rolled down depending on the direction, of course. But that's all to do with having a tight trading plan for how you're going to manage that sold call. The other thing to say is, of course, during earnings is if you're holding any long-term position, is a tricky part. So there are tactics we use. There are tactics we use to manage that. We can put additional put protection in place, particularly most of the stocks that we'll be interested in looking at, the high liquidity ones, as I said before, also have weekly options over them. So we may even put some extra put protection underneath. We may also choose not to sell a call, so there's no there's no risk cap until earnings is gone, which allows the underlying to move up as much as it wants, and we profit from it. So there's a few tactics around that which would be obviously part of your trading plan system for this, and really is vital. And although it may seem tempting just to give this a shot, if you give this a shot without some extra information, you're probably not going to serve yourself well. You're going to learn the hard way, as many of us have in the past, of learning by donating, which is never the best way to go. Okay, so that really is the essence of the strategy. Now, just to answer an earlier question, there was an earlier question on the wide bar, and I know that's got some interest on this. I'm just gonna flick back through the questions. Apologies, just to find it. Do you buy? Yeah, that's exactly what you do. So there are ways to be able to tell. There are ways to be able to tell it's a wide bar towards the back end of the back end of the day, and that's when you may enter it. You may enter your credit spread up or down. So here we go. So here's one last one for your T. Let's do this quickly. So here T was trading at 36.25 earlier in the day. So if we entered a 36 position, our call is 190. There's an example again of the put being more expensive. So we've got a net credit. Sorry. Our sold put bringing in more premium, not being more expensive. So a net credit of 75 cents. There's our 265 for that. So that's this one, and there's our first one. So 190 and 265. So net credit of 75 cents. The put cost, let's say 215. So the total investment is 140. And if we sold a March 37 call, so again, out of the money, so it's got plenty of room to move to the upside. Gets 48 cents, and that's 34% return. And that's just month one. Okay, but as I said before, oops, sorry, got a bit carried away with the pen. There are things that you need to know. So what I've done is I've put something together for you if you're interested. So first of all, we're going to give you my favorite indicator. So there's a wide bar course. This is on demand, so you get this immediately. So if you're trading credit spreads at all, this is 2 hours of learning on credit spreads and using that wide bar. Also included within that session is how to avoid the 5 key mistakes with credit spreads. It doesn't work in every market. There are particularly good market situations for it, and we may be coming up to one now. But importantly, as most of you won't use Hawkeye, we know how to use common indicators to get the same entry, and all the trading rules for this strategy, and also cover a little bit more on matching strategy to market. So there's the link at the bottom, that hawkeyetraders.com/PUB, and it's an investment of $97. But really, for most of you, that's a big added value that I've put in there. For most of you, we're going to do a live session on the no money down. So it will take what you've done today and it'll take it to the next level. So we will be talking, we'll be giving more examples, we'll be talking about all of the trading plan components that you have to have in place, including the vital management of the sold call. We're going to give you a brief introduction to some of the advanced techniques related to this strategy. So what we would do around earnings and things like that. There's a particular approach. We may also choose to close out that bought call sold put position, leave the bought put in place until the stock drops, to then put another no money down position for no extra cost. There's how to move the whole position out. If we buy initially a 6-month position, the decisions behind rolling the whole position out for another 6 months or 12 months. So all of those things will be covered in this no money down webinar, which you'll be getting the link for tomorrow for those of you going to move forward. And for those of you going to enroll in the next hour, we've also got a special offer to access our Trade Alert and Portfolio service, which run in Hawkeye Options, which has all the strategies that you're already familiar with. So at this stage, there's 2 diagonal call spreads, and there'll be this SLV bought call, and there's a spread in there as well on XLU. So you're going to get 30 days, the opportunity to access that for 30 days as well. So in terms of the investment of $97, it's almost a no-brainer. And but as I said, if the no money down strategy has grabbed you, then really it's a session you must attend. Don't have a play with this without getting the full story, or at least a fuller story. So that's really, really important. I can't emphasize that enough. So look, I'm going to quickly check through the questions because I know time is running on with us. Really appreciate all of the input that you've given so far in the session, in terms of the questions that you've asked, which have all been fantastic. And as I said, really makes a difference to me teaching from this side of the computer screen. So thank you again for that, and for your investment in time. And just going to quickly have a look. I think I have answered everything. I'm just going to check. Oh, I've gone way back. Hang on a second. In terms of you guys doing your options, what I'm going to do is, if you are, let me know. Drop me an email if you're going forward with this. There's a Kickstart options course I'm going to give you access to as well. No, I think we've answered them all. So look, thank you so much, guys, for being with me today. I hope that's been interesting. It's something probably a little different that you haven't heard before. If you don't get it fully, that's okay. Come to the session. Yeah, come to the session, and all will be revealed and explained in more detail. Obviously, there's that other My Favorite Indicator course, which is 2 hours of education on credit spreads, which, again, look for what you're paying for this. You know how much you can win or lose on a credit spread if you do it right or don't do it right. And there's the access to the trade alert. So thank you so much. And yes, as Jan has put up there, you can email me directly at mike@hawkeyeoptions.com with any questions. So my name is Mike Smith. Take care, trade safe, and learn with a passion, because it'll always make a difference to your bottom line results. See you again soon. Bye-bye for now.